Hey all, welcome to Share Trek. This is Raj here. Friends, I'm looking forward to the weekend and I hope that you guys have a great weekend out here. We are planning a longer weekend and I'm going to try and see how I can get more content into the channel. But I might try to go somewhere just for a break. The weather is also good here. So that's the plan. And I'm thinking that have you been wondering what actually is happening in the market since the overall environment looks perplexing right now? Well, keep watching because that is what I'm going to unravel in this video today. And we are also going to do a little bit of technical analysis in the end and try to see if there are any bullish or bearish signals in the watch list companies that we have. And then we'll wind up this session. So with that said, let's get started. Welcome back, friends. The number of job layoffs has increased fourfold compared to the previous year, and the media sector and the tech sector have been hit the hardest. The media industry has experienced a record number of job cuts so far this year, while tech job losses are at their highest since 2001. And with the exception of education, government, industrial manufacturing, and utilities, all industries have seen an increase in the layoffs this year. In May, the tech industry experienced a significant surge in layoffs with over 22,000 job cuts, which is a 2,939% increase compared to the same period last year. And overall, the total number of layoffs in May were 20% higher than in April. So since January, companies have collectively eliminated 417,500 jobs, which is the highest number of job cuts in the first 5 months of a year since 2020. If we exclude 2020, which was heavily impacted by the pandemic, this year has witnessed the highest number of layoffs in 2009 during the financial crisis. It was said earlier that tech companies had misread the trends and had overhired because they did well during COVID when work at home was happening and everything was going online. But at the same time, if you look at the stock market today, tech is doing extremely well. The FANG stocks are on fire. One reason why tech companies could be on fire is also because layoffs reduce the operating costs and add to the bottom line. That boosts the share prices. And some companies took advantage of the low share prices and bought back stocks. That again raises the share prices. So that's what I think makes me feel that what is good for the economy may not exactly be good for the stock market and vice versa. So there lies the perplexity. We have to remember what is the point of view from which we are looking at it, because the economy is like a huge elephant and sometimes we are touching the tail and we think the elephant is a rope. Sometimes we are touching the leg and we think that the elephant is like a pillar. So we do not get the full picture because it's difficult to comprehend. Now, coming back to the original train of thought, it should be noted that despite the increase in layoffs, the national unemployment rate remains low at just 3.4%. In fact, it's the lowest unemployment rate since 1969. And I saw President Biden claiming that he has created the highest number of employment, some 450,000 odd jobs, which is more than the previous presidents combined, past two presidents combined. So, of course, he's also quoting exact figures. So when you look at this whole scenario, it becomes a bit unwieldy for retail investors like us to make sense. Companies' hiring plans for the rest of the year have also decreased compared to last year, and the labor market appears to be slowing down due to factors such as inflation, high interest rates, and concerns about potential recession. As a result, companies have announced their intentions to hire just over 100,000 workers this year, which is a significant decrease of around 83% compared to what they had planned to do somewhere around May 2022. This level of anticipated hiring is the lowest in nearly 3 years, dating back to the time of the pandemic. So that's the kind of references that we get. On one hand, a record number of jobs has been created. On the other hand, there is a record number of layoffs. And so to put all these pictures together and try to make sense, knowing fully well that these jobs have gone from various sectors and each sector has its own individual issues, positives, negatives, and strengths. It becomes very, very difficult. And that's where, if we keep this in the back of our mind and then look at our stocks, we'll get a slightly better understanding than otherwise. And if you look at the banking and retail sectors, they have also experienced significant job cuts. Who can forget the SVB bank crash and a few more banks that crashed, Signature Bank, I think. Banks have announced nearly 37,000 job cuts up until May, which is 4 times the number compared to the same period last year. In the retail industry, over 9,000 jobs were eliminated in the month of May alone, making it the second highest industry in terms of job cuts during that month. These layoffs have been concentrated in specific locations. California, the home of Silicon Valley and a hub for the tech industry, has been hit the hardest, with job cuts increasing tenfold from the previous year, reaching a staggering 151,300 as of the month of May. Following California, New York experienced a significant number of layoffs as well, although the figure was approximately 1/3 of the layoffs in California. According to a recent report from the Labor Department, the number of new claims for unemployment insurance in the United States rose to 261,000 last week, reaching the highest level in nearly 2 years. This increase in claims reflects the impact of recent layoffs in the tech industry and other sectors, which are now starting to affect the overall job market. This jobless report provides further evidence of a cooling labor market following mixed signals from the May unemployment report. Despite the addition of 339,000 jobs, the unemployment rate rose to 3.7%. This increase in unemployment was driven by major job cuts at tech giants like Amazon, Google, Meta, and Microsoft. On the other hand, the number of continuing claims, which represents people who have been receiving unemployment benefits for more than a week, decreased to 1.76 million. This is a positive sign, as it indicates that people are finding employment soon after losing their jobs and they are getting off unemployment. This figure is at its lowest level since mid-February, suggesting that hiring is still happening at a healthy pace. Now, let us take a pause out here. If hiring is happening at a healthy pace, that means there is a demand for people, and therefore it's going to be supportive of inflation. At the same time, people losing jobs. So there's a lot of churn that is happening. I don't know whether it is people going from one vocation to another, one type of job into another, or people in the same industry losing a job and getting into another company and getting better salaries. I don't know what's happening out there, but that will be some qualitative information. If we can make some more conclusions. However, coming back to consumer confidence, it's currently at a 6-month low. This indicates that despite the conflicting statistics mentioned earlier, individuals are feeling apprehensive about the future. They are looking at the potential interest rate hikes, and also they are looking at inflation, and they are looking at the possibility of a recession. And therefore, they are a bit worried, and they are trying to save up some money, and that is going to help reduce the inflation rate because the spending will be under check. So in conclusion, the job market is currently experiencing significant shifts and challenges. Layoffs have increased across various industries, particularly in the media and tech sectors. While the national unemployment rate remains relatively low, companies' hiring plans have decreased compared to previous years, indicating a slowdown in the labor market influenced by factors such as inflation, high interest rates, and concerns of a potential recession. The banking and retail industries have also witnessed substantial job cuts in specific regions like California and New York being significantly impacted. However, it's important to note that the stock market, particularly tech stocks, have been performing well despite the job losses in the industry. While there are conflicting statistics and indicators such as decrease in continuing claims and addition of new jobs, consumer confidence has dipped, signaling apprehension about the potential interest rate hikes and inflation. So with that conclusion in mind, it will help us as we navigate these complex dynamics. It's crucial to stay informed and adapt to the evolving job market landscape. That's why I gave you a summary of all that. Keeping all this in mind and knowing that trends can shift rapidly, it's essential to consider various perspectives and data points while analyzing the state of the market. And that's exactly what we are doing today by looking at all these various signals. Now, I think it's time for us to go and have a look at our watch list companies and see if any of them are showing bullish or bearish technicals. And with that, I think I would like to round up this video. So let's go to the TradingView platform right now. Well, friends, here we are in the TradingView platform, and I'm looking at the Nasdaq futures out here. Nasdaq futures are mildly positive. It's 29th of June 2023, and it's around 9:43 p.m. And the Nasdaq is showing a little bit of positive out here. Let us go on to look at the indicators and see where QQQ landed up. QQQ landed up down minus 0.20%, and still it's in a bull channel, as you can see here. So nothing to worry about. And if we zoom out, we can see that we had fallen deeply into the bear channel, and somewhere around 18th of October, we started recovering. Then we dropped again on 3rd of January, beginning of the year. And since then, we have not turned back. We have been going on an upward march. And at this point of time, if you look at the MACD and if you look at the RSI, I think the RSI has got plenty of room to run. The momentum is pretty good. And the MACD is a bit bearish, but we'll have to see what happens tomorrow. And that will determine the direction. Now, coming back to VIX, we haven't seen the VIX in a long time. As you can see, VIX is below 20. So I'm really happy out here because this suggests that there can be good swing trading opportunities. And that's what we'll try to find out in our session today, if there are any opportunities like that. When I look at the market movers, FNGU, which is my favorite, I still have FNGU stocks in my portfolio. I have 100 of them, and it's looking extremely positive because I bought them in double digits. And Meta is also something that gives support to FNGU. It's a component of FNGU. It's also on a bull channel. And if you look at Microsoft is also on a bull channel. And in fact, it has got a new sharper bull channel. It's going from strength to strength. I would say this is the next bull channel that we have. And then if you look at Apple is also on a bull channel. After the cup and handle, we met and exceeded the target, and we are going up further. And if you look at Amazon is also on a bull channel. So all the big guys are in the bull channel. And of course, IBM is also doing pretty well. The AI factor is influencing IBM, in my opinion. And now let us go and have a look at genomics. And I'm going to sort this out so that we have the winners today. Schrodinger has been a winner. It's been up 6.27%. I do not see any technical signals out here that I can talk about, but it's on a bull channel, so it's looking good. Bionano has been a bit positive today. Let us see if it has got any news item. It says Bionano announces Stratis system for OGM and VIA software for hematologic malignancies. It announces a Stratis system for OGM and VIA software. Yeah, so this announcement has possibly given it a bullish jump. I'll have to take a quick look at Bionano Genomics. Another subscriber had commented about Bionano Genomics. We'll check it out later in the week. IMTX has done extremely well again today. And if I look at this, I can see a bullish pennant out here if I take this out. So this is a bullish pennant that I see here. I'll make this green because this is a support. So it has to break out on the upside, and its resistance is 12.71. Caribou Biosciences, I do not see any patterns out here that I can talk about. PACB, I don't see any patterns out here that I can talk about other than saying that it's on a bullish channel. SQZ Biotech, I don't see any patterns out here. Illumina, I don't see any patterns out here in Illumina that I can talk about. Sarepta, no patterns to talk about. Teladoc, nothing. Teladoc, yeah, I don't see anything out here that I can talk about. ArcG is also doing okay, nothing to talk about. CRISPR Therapeutics, I don't have anything to mention about in major. I would like to think of this as a bullish pennant. I attempted it once, I attempted it twice, but I'm just going to give up on this. I don't know what's happening here, but I think personally I feel CRISPR is underpriced right now. I bought it at a higher price. I bought it somewhere around 59 or something, and since then it has fallen down, so I'm a bit sad about it, but anyway, it will come up. DNA, let us look at DNA if it's forming any patterns. I do not see any specific patterns in DNA, but it did lose a cent today. And if you look at Invitae, I don't see any patterns to talk about. Allogene, no patterns to talk about. Prime also, I don't have any patterns to talk about. Fate, no patterns to talk about. Intelia wasted the cup and handle potential. It has come down. It is struggling under the resistance of 42.08. It has to break through this, and then the next resistance will be 43.64. Right now, it's looking weak. I don't think it's going to be able to break through. Editas, Editas, I don't see any patterns as such. It is mildly bullish out here. If I were to take a trend line and connect all the bottoms out here, so this seems to be a kind of mild bull channel that we have out here. We have to see what happens going forward. I don't think it's going to be able to hold on because the momentum is very low, and also MACD is bearish. But who knows? Tomorrow something better can happen. And in terms of news, there has been no news since January 16, and there is no catalyst as such. Verve is doing well. It achieved the cup and handle pattern target, and then it came back down again. Right now our resistance is 20.82, and as far as the MACD is concerned, it's okay, but when it comes to the momentum, even though it's above average, it's pointed down. So unless we get some positive catalyst, I don't see this coming up. And here is an article from Dow Jones dated June 15th, which says Verve Therapeutics share raised 12% on Eli Lilly research deal. We did a video about this, friends. Then Beam Therapeutics, I don't see any trend or pattern out there that I can talk about. Bluebird also, I don't see any pattern to talk about. The Bluebird has wasted the cup and handle pattern out here. I bet on this cup and handle pattern. I bought at a higher price and now it's languishing. So I'm not very happy about it. So friends, regardless of whatever technicals we do and fundamentals we do, it doesn't work most of the times. I do doubt sometimes whether fundamentals and technicals have any bearing at all, because the market probably responds to various other stimulus, sometimes overly and sometimes underwhelmed. So I still consider everything very perplexing. I do not have the confidence in general to actually put money into any of the stocks. And the two that I did recently, that is CRISPR and DNA, both have not done very well. The ones that did well was FNGU. That's where I put some money. That did very well. I also booked some profits. So I'm going to take this opportunity. If it goes on further, I'll buy some more of DNA or CRISPR, depending on what I get to see. But personally, I feel DNA is much lower risk because the downside is limited compared to the upside. So I would rather put more money in DNA right now rather than in CRISPR. That doesn't mean CRISPR is a bad company. It just means that I'm not rich enough to buy CRISPR in large numbers. So friends, that brings me to an end of this video. And but before I go, please, I would request you that if you have not yet subscribed, please subscribe. It's free, and it will help us push our channel above 4,000 subscribers, and that would be cool. Thanks and have a great day and a great weekend going forward. Bye for now.